That's what it means when you're having a good time. Time flies. Time
Exactly
flies when
right.
you're having fun. Now, when we get our superannuation, which of course happens automatically as soon as you get a job, you sign all the paperwork, you've got the compulsory superannuation guarantee. Normally, when that's set up in the first place, it includes an insurance coverage, doesn't it? But you don't necessarily have to maintain that coverage. You do have options about what you want to do with that package.
Yeah, exactly. Look, I think it's very topical at the moment, obviously, with people looking at budgeting and people generally maintaining some fairly solid mortgages. More and more people are asking to have their cover held through super, and look, there's pros and cons to it, like most things. And I think today we'll touch on some of the key things about what to look for, what you can have, and some considerations in relation to your broader strategies. But you're spot on. I guess we could start with the fact that not all super funds offer default cover. A lot of the industry funds will, because that's a way to obviously ensure some free revenue, which can be a good thing for people who.
I thought it was out of the goodness of their hearts.
Of course. They
want to take care of their customers and make sure that they're properly provided for.
Exactly right. So generally, we see that people have life and TPD, or total permanent disablement cover, through superannuation. You also have the ability to hold income protection through superannuation. But as I said before, there's pros and cons of both structures, and I think it's really important that people have a think about a few key things, because as they say, all cognac is brandy, but not all brandy is cognac.
That's one way of looking at it. Yeah.
This is very similar to that. So there's one time in your life when the definitions and the wording becomes vitally important, and it's to do with insurance, and especially with insurance through superannuation. So we'll touch on some of the key things people should look out for, and making the most of a way to fund their insurance without having to touch personal cash flow or after-tax wages.
Now, some people have suggested that when you're at the beginning of your working life, you're in your 20s or even in your 30s, maybe you don't need to have life insurance cover in your superannuation, because you might prefer to have all of the contributions being directed towards your actual superannuation fund rather than some of it being diverted off into insurance coverage. Is that a smart move or not?
Yeah, look, I think, again, it's a case by case, because people have different priorities at different stages of their lives. Generally, you find that younger people have much larger mortgages, and they'd like to be able to focus on paying that down. They may also have growing kids, so you've got school fees and living costs and all of these sorts of things to consider. You've also got potentially, a spouse on mat leave. So that can have a significant change to people's cash flow as well. So I think younger people are able to have their cake and eat it too, but you need to keep in mind the fact that, okay, your balance of your superannuation is going to go down. By comparison, so is your after-tax income if you hold it outside of super. People can also make additional contributions to super to claim a tax deduction, which could then go to replenishing some of the money taken to pay the insurance premiums through the super fund. So I always say to people, there's always a give and take, and finding something that suits your budget and your situation is very important, because everybody's a little bit different. Holding life and TPD for younger people through superannuation allows them to free up personal cash flow, where, as I say, you may have situations where you're contracting, you've just finished studying, you're working your way up the corporate ladder to earn more and more money, so you may not have a lot of disposable income. So holding cover through super and having what you need may be outside of your cash flow ability.
Yes.
So super is a good way to have what you need, especially with some of those key things like younger families and bigger debts.
Yeah, now a lot of younger people might think, I don't need life insurance at all, I'm going to live forever, or at least another 50, 60 years. So they might say, well, I'll postpone having life insurance until later on when I feel like I really need it. And that may be true for some people, but I guess as soon as you buy a house, you really do need to have some kind of life insurance coverage, so that should the worst happen, your family can still keep the house. Now, that being the case, is it better to have your life insurance held outside your superannuation, or is it better to have it inside the superannuation?
Okay, so when we're thinking about where to hold it, the first thing we need to think about is, where's it going to go? Because one part of the discussion is the need, and if you strip out most couples or individuals and say, if I didn't have the ability to earn money, okay, income protection is a wonderful thing that can also provide you with a tax deduction, and most people aren't aware of that. Income protection is generally tax deductible to the individual, so you have a choice on that front. Do I pay tax or do I not? Do I get something? Do I not? So I'm a big advocate of income protection because as the person that's paying it out, we pay out a lot more of that than just about any other form of cover. In relation to life and total permanent disablement, if you think about the implications of that, if you took yourself out of your family environment, could your family sustain the lifestyle that you have and service the debts you have on one income? Generally speaking, most people fund properties and live to their means with a dual income environment where there's a partner involved and some children. So if the money is going to go to a dependent, then it would be appropriate to hold the cover through super, because under the legislation, money paid to a spouse through a superannuation insurance policy is tax-free. If you're going to give the money to an adult child, then you would look to hold the cover outside of superannuation, because an adult child is not a dependent under the SIS Act that governs how money is taxed when it's paid out in relation to life insurance proceeds. So I'd start and say, okay, what do we need? And then work that out. The second consideration I would have is then to say, right, where is the money going to go? And then you would look to try and maintain the appropriate structure. And it may be that some's inside super and some of it's outside of super, depending on the purpose or the why that you're creating the policy for.
Now, I don't know, I could be right or wrong on this, but if you start off with, say, insurance inside your super and you change your mind later on and you want to have it outside, or vice versa, the other way around, I would imagine that's a little tricky to do.
Yeah, look, again, it depends on the policy provider and how it's structured. So generally speaking, you can move a policy from superannuation to your own name without having to undergo new medical underwriting, depending on your personal situation and the provider that you're with. That may not be the case with industry funds and contracts that are held through a retail superannuation fund. But if you have a policy in your own name or a policy through superannuation fund that is provided by an insurance company and not the fund that you're with, then you generally have the ability to do what they call a cancel and replace, which allows you to simultaneously take the policy out of superannuation, for example, and start it in your own name without having to undertake any other sort of change in underwriting, because you're staying with the same provider and they're maintaining the same risks that they're already bearing with you when you took the policy out originally. So you can do it, and this is where reviewing your situation and understanding where the money's going to go and why you have the cover is really important, because in that situation, if the kids do, cease to be dependents under the legislation, then holding cover outside of superannuation would be far better from a tax perspective than holding it through super. We generally find that people set these things up and then the years slide by, and before you know it, the kids are 35 and you're maintaining the same cover without a mortgage, without young children. And I always say to people, just check and make sure that your why still lines up, because it's something that people need to be mindful of, because you don't want to be paying for something that ultimately you don't need.
Well, that's right. And I guess the way you've explained it there, it's simpler than I feared it might be, but still a little bit tricky. So you've got to make sure you dot your I's and cross your T's.
Yeah, and it definitely comes down to how your product or your policy has been set up and the provider and the rules around what they're going to offer. Because a retail contract offered by an independent insurance company, they can create a superannuation-based policy that would allow you to roll over money from your superannuation to pay the premium. It doesn't have to be underwritten by the superannuation fund that you are with. And what I mean by that is, let's just pick a company. Let's say you had an insurance policy provided by OnePath, okay? And you are with an MLC superannuation fund. If the OnePath contract is the best contract available for you at the sharpest price, you can use your money from your MLC superannuation fund to pay the policy at OnePath. You don't have to have an MLC-based insurance policy just because your superannuation in this example is with MLC. So there's a huge, broad, well-structured market there, and it's a very, very innovative market as well. So competition is, sharper than it's ever been. And I always recommend that people shop around and make sure that you understand the policies that you have, you understand the definitions that you can maintain, you understand the structures, and then obviously look at the ongoing premiums that you're paying, because there can be some significant differences in cost depending on the age and the quality of your contract.
I'm 2CC Canberra Live with Leon Delaney until 6 o'clock, and I'm with Luke Smith from Envision Financial. Today we're talking about holding insurance through your superannuation, and we'll be back with more details on that topic in just a moment. see Canberra Live with Leon Delaney until 6 o'clock, and between now and the end of the hour, I'm with Luke Smith from Envision Financial. We're talking finances, and today we're specifically looking at holding life insurance and other forms of insurance through your superannuation. Now, Luke, we've talked a little bit about some of the benefits, but what are some of the things that people should consider before deciding which avenue is best for them?
Yeah, look, I think this is, again, as we touched on before the break, one of the things that people need to keep in mind is the devil really is in the detail here. And when people are pricing contracts, it's important that people understand the benefits and considerations that they have under their existing policy and the benefits and considerations that they'll have under a new policy. So some things I consider before making any changes are check your total permanent disability definition. Now, there's an any occupation definition and there's an own occupation definition. And as the words sort of state, can I perform my own occupation at the time of claim? Or could I perform any other occupation that I'm suitably trained and qualified to undertake? So there's a significant difference in the quality of that definition, and that will be very important depending on what sort of job you have. I'd also look at benefit periods, waiting periods, and some of the pre-disability income considerations for income protection. And this is where I'd also say that people should also think about taking advantage of super linking. And this is an initiative provided by insurance companies where you can have part of your cover held through superannuation and you can have part of it held outside of superannuation so that you can get access to the best possible definitions, because there are some things offered through an income protection contract that are not payable under a superannuation fund. So that really points out to me that income protection is one of the things where what you could claim on and ways you could be paid very good money can be very, very different when you're thinking inside or outside of super, as well as the tax implications, because most people have a marginal tax rate that is greater than 15%.
Yes, I was going to ask specifically, is there a simple tax advantage in just putting all of your insurance inside the superannuation fund because of that 15% rate?
Well, again, it depends on what you're putting in there. So if the benefit's going to be taxable to non-dependent children, the tax deduction that you're going to get at 15% will be outweighed by the tax that you'll pay. From an income protection perspective, I generally say to people, you'd only put income protection in super if you couldn't afford it outside.
Right.
And I say that because if you're earning $100,000 and you're paying tax at 39%, or 34 to 39%, let's say, that is far higher than 15% in the super fund. So you're actually robbing yourself of a potential tax deduction. So it really comes down to what you earn and the size of your benefit and where the money's going to go, as to whether you keep it inside or outside, and then also overlaid with the definitions and benefit payments that you could receive depending on how your cover's structured. So it's a little bit more complicated than people realise, because the devil is in the detail. Another thing I'd think about before making any changes, obviously you always take out new cover before your existing cover is cancelled.
Oh, yes.
Because if there's anything found in relation to medicals or underwriting questions or anything that you may not have known about, you don't ever want to cancel anything before you've got new policies in place so that you're insured at all times.
Yes.
Some other things I'd consider as well is the waiting period and the benefit period for income protection. We may have touched on that one a little bit earlier, but those two are very, very important. People should review that depending on their situations and needs, because obviously if you have access to cash or you have money in an offset account or a redraw facility and you could cover yourself for 3 months, extending the waiting period on your income protection contract could reduce the premium quite significantly and also then provide you with cash flow savings in your own name. So it really is something that people should be looking at regularly, because people's situations over a number of years can change and people's remuneration can increase. So you need to make sure that your monthly benefit for income protection is in line with what you are earning. And obviously the waiting period and the benefit period are relevant to your current situation, because it is something that does evolve, and these are living, breathing things that should be checked regularly.
Yeah, that's right. Reviewing your situation on a regular basis is always a good idea in any context, really, because I know there's a big temptation for people to set and forget, and it's the forget part that can bite you in the end, isn't it?
Yeah, look, we found one the other day where we had somebody come in thinking that their life cover was through superannuation and it wasn't, which had meant they'd missed out on a 15% tax deduction on a significant number. which ran into the thousands of dollars. So it is something that people need to understand. The worst thing someone could do generally is assume, because generally the assumption's not the reality. So they're the sort of key things I'd think about. Look at your TPD definition, look at your waiting period and your benefit period for income protection, look at superannuation to manage your budget, because what you think you need and what you may need in relation to achieving your objectives may be outside of your cash flow. If you don't use superannuation, as we said earlier, for younger people, if people are getting older and they want to move policies outside of super to bolster their super fund, they can do that. They could also look to make additional contributions to superannuation, either by claiming a tax deduction or using the non-concessional contribution rules, which means that after-tax money goes into super to top up money that would have otherwise been taken for insurance policy premiums. So it's really just about looking at your broader situation and making sure that your asset accumulation and your wealth protection coincide and they live harmoniously together, and you keep moving forward in the right direction, taking into account your situation and needs each year.
Only a couple of minutes left, but are there strategic options that you can make use of your insurance inside your superannuation, or outside for that matter, in a way that helps advance your wealth building strategies?
Yeah, look, some quick takeouts there. Obviously, review your cover, understand what you've got and why you've got it. Keep your any occupation TPD definition inside of super, and look to link the own occupation definition outside, especially where you have a specialisation or a white collar job that is obviously not something that could be easily replicated if you lost your ability to work. Make sure you understand your income protection definitions. I'd look to hold income protection in your own name if you can, because of that ongoing tax benefit, because your marginal tax rate is generally higher than 15%. Or if cash flow is an issue, look to super link your income protection so that you have all of your superannuation definitions that could be paid, funded out of superannuation, and all of the other ancillary benefits outside, because in a good income protection contract and have you paid in so many different ways, I'd be thinking about those. I'd also be looking to, if you want, use personal money to pay the premium of an insurance policy and then claim a tax deduction against your $25,000 concessional limit. So 2 ways that money can be paid. One can be a rollover from super, the other one can be from your own name. So look at how it's structured so that you can maximise the tax efficiency of your contract as well.
And Luke, where can we get more information?
Yeah, so obviously www.envisionfinancial.com.au, that's Envision with an E. We've got the strategy stacker, Luke Talks Money on iTunes, and obviously we've got YouTube, Envision Financial Canberra, where you can subscribe to that and catch the shows and have all of the key takeouts on the videos that we have for people there as well. Or pop in and have a cup of coffee and we can check your policies at no cost and make sure that you're not paying for something you don't need.
Fantastic, Luke. We'll catch up with you again next Friday.
Beautiful. Thanks, mate. See you.
Luke Smith from Envision Financial on Twitter.